I'm delighted to get the next manager on. Again, the focus is going to be UK equities. It's an interesting time to take a look at UK equities, particularly when the growth versus value debate is going on. UK much more sort of structured towards the sort of value end of the market. Let's go and take a look at what Craig Yeaman from the RL Opportunities Fund has to say about the outlook for 2022 and how he thinks about picking some stocks. Welcome back to Vantage. We have another manager focused on UK equities. Delighted to have Craig Yeaman from RL Opportunities Fund with us today. Craig, great you could join us. Before we get into learning more about yourself and the fund, I think it's a good place to start. Let's talk about your view for UK equities, particularly in light of, I guess, the push-pull factors. You've got rising inflation, rising rates, yet the prospects of economic recovery are there in the sort of post-pandemic era. How are you looking at the world right now?
Yeah. Well, good afternoon, Neil. Great to join you. It's been an extraordinary start to the year. If you look at the UK market and you look at the FTSE 100, you've seen BP has outperformed DECRA, for example, by over 40% in a month. So really violent moves. But in terms of how we're seeing the market and the outlook, we're very positive in the UK market. Mm-hmm. We're positive on the outlook for the economy. If you look at the latest IMF figures, they're expecting growth of somewhere in the region of 4.5% to 5% this year. Yeah. So from that point of view, we're very positive. And inflation is here. Now, whether it's transitory or whether it's here to stay is a question up for debate. We think it's probably here for the short term, and then it will probably dissipate. But obviously there are rate increases due. That's priced into the market, I would say. Yeah. There might be 4 or 5 this year, we don't know. But we think the Bank of England will be able to control inflation. But inflation is definitely here at the moment. So there are some very violent moves within stock prices that we've seen so far this year. In terms of the UK Opportunities Fund and how we're positioned, we've not really done too much, to be perfectly honest. We've added some more exposure to the likes of Glencore, Shell, the banks. So we've added some more Lloyds and One Savings Bank in. And we've also taken the opportunity of the growth stocks being derated. So I'm not going to front run a stock, but we're in the process of buying one at the moment, what I would term a growth stock that is materially fallen over the course of the last month.
Okay, so a chance to reassess, but also I guess what the clues in that are that you're positioning yourself. Banks will do well typically in a rising rate environment, so you're positioning your portfolio for that kind of environment. We'll get into a little bit more of the detail, but it'd be useful for our audience to get to know you a little bit. So why don't we start with a walk through your journey into fund management, and in particular how you ended up in the current role?
Yeah, absolutely, Neil. So I've now been doing this job for 23 years. So when I left university, I joined one of the major banks' graduate programs. I always had an inkling that I wanted to do fund management, but of course the difficulty is getting into the role. So I started on the graduate program. I then moved into the investment department, and that was my big break. And whilst I was there, I joined in '99 to the investment department. I analysed funds, fund managers and stocks. Mm-hmm. And I did that for a few years before moving to Glasgow Investment Managers back in 2001. And Glasgow Investment Managers was best known for running investment trusts. So whilst I was there, I ran Shire's Income, I ran Shire's Smaller Companies as well, and was very happy there. And in 2007, the company was bought by Aberdeen Asset Management. So I moved there for a period of time before moving to Saracen Fund Managers in 2008. Mm-hmm. So whilst I was there, I ran a fund very similar to the one I'm running today. It was a Best Ideas UK all-cap fund, and I ran that for 9 years. Performance was reasonably good. It was first quartile over 1, 3, 5 years and so on. And then I was approached by Royal London. So they had an underperforming fund called the UK Opportunities Fund, and they wanted me to come in, have a look at it and see if I could turn around performance. So I decided to join them at the back end of 17. And touch wood, performance has been reasonably good since I joined, and it's first quartile over over 1 and 3 years to the end of last year.
That's great, and congratulations on that. Given the length of time you've been doing it, curious as to whether there are any sort of rules of thumb or sort of key philosophies that you operate on. What keeps you on the rails?
Well, I run models for every company that I invest in, and I try and look through short-term noise. Yeah. Because as we know, stock prices can go up or down too far in either direction. So I try and look through the short-term noise and look at the actual value of a company in a 5-year view. That's what I try and do. And for me, the most important thing is you invest in good quality companies, and cash is king. Okay. And the more cash a business throws off, the more optionality it has.
Perfect. So tell us a little bit more about the RL UK Opportunities Fund. How big is it? Could you give us a sort of snapshot of the portfolio in terms of, how much is in large cap, mid cap, small cap, some of the sort of key drivers of it?
Yeah, certainly. In terms of the fund itself is a reasonable size. It's roughly 900 million. Mm-hmm. As I say, it's a UK all companies fund. It's a best ideas, so it's concentrated. So I will tend to have between 30 and 40 stocks at any one point in time. I think at the moment we're sitting with 35 stocks. So that's roughly where you would expect it to be. And in terms of the actual split, we've got 2/3 in the FTSE 100. Okay. And we've got the other third in small and mid cap, with the majority being in the mid cap. What I would say, Neil, is I tend to run fully invested funds, because my view is it's better to be in the market and people have given me the money because they want me to invest it. Yeah. So I tend to remain fully invested. Okay,
and you 2/3 in large cap, but a third of the portfolio in sort of mid and small cap. What does each bucket bring effectively to the portfolio? And maybe you want to just give us some examples of, so that we can illustrate this in terms of a name that you've invested in each sort of category: large, mid, and small cap.
Sure, I'll give you an example of each category. But really what I'm trying to do is invest in companies that over the long term can outperform the market. Mm-hmm. And by that I mean outperform in earnings, expectations, which is crucial, and then hopefully they can be re-rated. Before maybe going on to talk about stocks, Neil, you asked me earlier on about the areas I'm invested in. So, I'm overweight industrials. Yeah. I think industrials still offer exceptional value, and it's such a broad range of companies you can invest in. You're not investing into the same area. So if we maybe look on specific stocks, an example I'd give you in the small cap bucket would be a company called MJ Gleeson. Oh yeah. So MJ Gleeson is an affordable house builder in the north of England. Yeah. It's the fastest growing house builder of the listed companies in the UK. So at the moment, it builds approximately 2,000 houses. We think over the medium term that could double. If you look at the margin, stable margin business. But what we really like about the business is 80% of sales are to first-time buyers. 66% of buyers are what we would term key workers, whether that be nurses or lorry drivers, and the average selling price is £152,000. If you compare that to the next listed house builder in terms of valuation, it would be Persimmon. They're well over £200,000. So there's a real air of differentiation for them. And it's a very strong management team that MJ Gleeson have. And really we think they will benefit from, it sounds perverse in a way, the end of Help to Buy. Yeah. But a lot of these other house builders were using Help to Buy, not so much with MJ Gleeson, and they have their own schemes. So we think longer term, MJ Gleeson still offers exceptional value. Okay, a good resilient small cap name. How about a large cap and a mid cap? Yeah, if we look at mid cap, the name that would spring to mind straight away would be Watches of Switzerland Group. Mm. So that came to the market a couple of years ago, and I would like to say I invested at the IPO. I didn't. I invested at the beginning of last year, and it's been a tremendous performer for us since. So that just shows you, because you miss out at the initial stage, it doesn't mean that you've missed it altogether. So since we bought, it's more than doubled. But why do we like the stocks? Well, firstly, we like it because it has very strong relationships with Rolex and the other luxury Swiss watchmakers. So they over-index in the actual stock that they're receiving from Rolex. We like them because the end customer is resilient. they're not as affected as other consumers in the market. So they're able to put price increases through quite comfortably. And actually, they're very strong in the UK. They're not nearly as strong in the US, but they've gone into the US. They bought a company called Mayer, and that they're doing very well with that. And we think they're going to continue to consolidate the US market and also look at the EU market. So why we like this, Neil, is the management have got a target of growing their sales by 20% per annum for the next 5 years. We think they're going to beat that. And because they've got operational gearing, we expect earnings to materially increase. And actually, it's on a very sensible rating. So as I look forward in my models 5 years, we think this still offers exceptional value at today's level.
Yeah, and I love those sort of stories that are proxies on brands, etc. And on the large cap side, is there?
Well, I'm going to give you another proxy on brands, and that's JD Sports.
Yeah.
So we like JD Sports for the same types of reasons as we like Watches of Switzerland. Once again, they have great relationships with the likes of Nike and Adidas.
Yeah.
They've gone into the US, obviously with the blessing of both Nike and Adidas, and they bought a couple of companies called the Finish Line and Shoe Palace, and these were underperforming companies. And you can see already the difference that management have made. Margins are moving up strongly. They have lots of cash on the balance sheet, so there's a lot of optionality, as we discussed earlier on. They have the UK pretty much sewn up, and now they're looking further east. So they're strong in Europe, but they're moving into Eastern Europe. We think that offers plenty of growth potential, and also the Far East. So if we look at JD and the reasons that we like it, well, firstly, it's been derated. Now, short term is not helpful for performance, but longer terms, that just gives us more confidence in the business. So the shares are off almost 30% over the course of the last couple of months. Actually, they've had a profit increase in terms of their guidance. So, short term, not helpful for performance. Long term, we're very, very keen on the stock.
Yeah, I mean, it's one of those names which I was sort of put in that sort of serial compounder type bucket. It keeps growing, and fabulous execution. A team that's delivered, and I think a lot of people envious effectively of the fact that they do have this Nike relationship. So as providing that continues, I can see that. And
that's exactly what we're trying to do, Neil, in terms of investing in compounders.
Yeah.
We try to buy a business because businesses evolve. So we never set price targets, we never set stop losses. We let businesses evolve and hopefully compound their earnings.
Yeah, I mean, you mentioned JD Sports is, has been buying some businesses, and we talked about these compounders. So, clearly one of the things when we're looking at your history is that you like buying consolidators of industry. You're strengthening your market position. You've got pricing power coming through. But the key is that they're funding that off their own cash flow rather than coming to you, right?
I think that's very important. If you are going to invest in a company that's looking to consolidate the market, what we don't want is them to continue to come and issue equity.
Yeah.
We like companies that can self-fund their own rollout stories. And JD Sports is a classic example, as is Watches of Switzerland, as is my largest position in the fund at the moment. It's a company called Ashtead.
Yeah.
And if we look back at the success of Ashtead, I mean, Ashtead is currently a 6.5% position. It didn't go into the fund as a 6.5% position, but it has grown materially, both its earnings and the share price. And we think it could easily double from here in terms of the revenue, in terms of the profitability. And they've done that through their own balance sheet.
So what kind of measures do you in terms of getting comfort around self-funding, what are the kind of typical measures that you're looking at? Is it, clearly you run your own model, so you've got the cash flows, but do you look at return on capital? What are the sort of key metrics that you...
We do look at return on capital, and obviously, as you would imagine, in today's very low interest rate environment, most acquisitions are earnings enhancing. So that's just a given in these days. But really what we're looking at is when a company is acquired, what's the underlying company doing? What can management do to actually improve returns? So return on capital employed is very important. But also, we don't like to invest in companies that are both operationally and financially geared. Mm-hmm. Good times you make tons of money, bad times you go bust. So if we're going to invest in an operationally geared company, we like companies that are lowly financially geared and vice versa. And actually, the companies that we've mentioned there, Watches, JD Sports, Ashtead, they all have strong balance sheets. So that's a very good starting point. And with the quality of management that all the companies exhibit, that gives us, really huge amounts of confidence in the future prosperity of that business.
Perfect. Now let me ask you, I mean, we try and sort of educate, people watch these programs to, educate themselves about investing in the markets. I wanted to ask you a question about, if you reflected back to the start of your career as a fund manager, knowing what you know now, what's been the biggest surprise for you, entering into the industry, and what's the biggest learning, I guess, in all those years of investing?
I think we touched upon it earlier, Neil, and that's the compounding effect of companies. You obviously have to invest in the right quality company, but let's look back at Ashtead, for example. So I first met Ashtead back in 2001, and between 2001 and 2008, the share price did very little. Roll forward to 2008, the share price was about 50 pence. You look at it today, it's over £60, and that's on a like-for-like basis. So if you invest in the right quality company and it compounds its earnings, the market takes heed of that, takes notice of it, and it re-rates it. It's a double whammy in the upside. Yeah. So, we discussed Watches of Switzerland, and I said I didn't invest in the IPO. You haven't missed the opportunity. It's all about the future prospects. So there's no point looking back. You always look forward. And as I say, it's about being patient. For me, I never set price targets. I let businesses evolve. And by that, you can make lots of money if you're in the right stocks. Of course, if you're not in the right stocks, another lesson that you learn over the years is you cut early. Yeah. There's no point holding onto a company that's not going to perform, in your opinion, because the opportunity cost of staying in that company versus investing elsewhere can be massive. Yeah. Listen, Craig, that's great. It's great to have you on the show. I would characterize that as someone who, looks for businesses which have got sustainable competitive advantage that can, grow and compound their earnings and can strengthen those sort of market positions. So effectively, those sort of self-help stories, which means that, whatever happens from a rates perspective or an inflation perspective, you're looking for names which are going to weather that storm, continue for the long term. We look forward to catching up later in the year, I hope, and seeing how 2022 pans out. Thank you very much for coming on Vantage. Neil, it's been a pleasure. Thank you.
Thank you.